Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me, the smartest guy in the room, Mr. Michael Becker. Michael, how are you?
Hey, Paul, doing pretty good today. How are you?
I'm doing good on this beautiful, very nice and calm fall day. So beautiful days outside coming to Texas. Are you turning on your air conditioning these days, or are you just...
I think it's going to be 9 degrees today, so not today. It's Texas, so not quite cooled off yet.
I haven't turned on the heat, but that most people are just still using their air conditioning these days. So some great information coming out of Michael Becker. As you know, Michael owns 6,000 plus units here in the great state of Texas. We call him the governor of Texas just because he owns so much damn real estate that the state of Texas should be picking him up on a limousine every day and bring him any place that he wants to go. Is there usually champagne in the back of that limousine that the state of Texas provides you every day, Michael?
Just the property tax bills, no limo, Paul.
That's too bad. So Michael, who, as you know, was a loaner of money and working for one of the largest commercial banks as a commercial real estate banker, threw his keys back to the bank probably about 10 plus years ago and decided to become an owner of real estate. And he's done a great job with his group over at SPI. So we really listen to Michael about being an operator and kind of be like the old commercial, be like Mike. You want to be like Mike in the future. So listen to what Michael says and get a gleam of what success looks like in multifamily. So, and again, if you think that we bring you any good information, go on to the Old Capital Podcast website, Old Capital Podcast website. And on there's a 17-page white paper report. And then also, too, if you could, give us a 5-star rating on iTunes. We certainly would appreciate that. We're trying to get 1,000 by the end of the year. And any good and kind words and maybe a 5-star review would certainly help us. We certainly do appreciate it. Again, oldcapitalpodcast.com. Thanks for helping us out. In the podcast today is a friend of ours that we've known for a long period of time. And he's going to be a friend of yours because I call this segment War Stories with Tony Lenamon. War Stories with Tony Lenamon. And Tony has been in this business for as long as I have or even longer. And he's kind of seen the ups and the downs. And he has just been in a real unique position because he has represented some of the largest appraisal groups and bankers and lenders and owners in the country. So I'm going to introduce you to Tony Lenamon. So Tony, thanks for coming out. We appreciate your time.
Paul, glad to be here. Thanks. So
tell us, Tony, give everybody who's listening to the podcast a little bit of your background and don't be shy.
Well, I got in the business in the 80s. I graduated with a real estate degree in 1988, thinking I might want to be a developer. And just about the time I graduated, Texas walked itself into the most impressive depression, real estate depression it had ever seen. Every bank in the country, in the state failed. I think 450 banks failed, and 9 out of 10 of the largest banks failed. And so they didn't, and every property in the state seemingly got foreclosed on. So they didn't really have a job called developer for me. So one of my mentors said, why don't you go hide out in the appraisal business for a while? I get the feeling that's going to be a good business for a while. So I got the appraisal business completely backed into it, as a lot of people do, and have been there ever since. And I worked at a few local shops back when local shops ran the business, and then went to Deloitte and did appraisal there, and then did consulting there. And then the last 18 years was at CBRE and ran their national multifamily appraisal group. And then in January, very happily, was recruited over to JLL and now run the JLL National Multifamily Appraisal Group.
Again, that's the national multifamily. He runs the entire platform for the United States. This is the guy that kind of knows really about what's going on across the country, and all the appraisers kind of report to him. He's an administrative position now. So he is overseeing the appraisers that are appraising multifamily properties for you. If you're a buyer of the property, you want to have another set of eyes. The bank wants to make sure that the appraiser agrees with you of what you're paying for this property. They want to make sure that they understand a little bit about who the seller was, what the economics of the property were. And so Tony, who has a great in-depth experience on multifamily, is certainly a welcome guest to the show. So again, I'd love to talk about war stories, and we'll get to today. A lot of people that have joined the multifamily business in the last 5 or 10 years really have not understood what the history is of multifamily. You just kind of gave us a peek that back in the mid 80s, the late 80s, when you were looking to become a developer and trying to start building apartments, that whole market had collapsed. Talk a little bit more about some of the things that led up to the collapse of, say, right after 1986.
Yeah, sure. Well, there's a lot of good takeaways for today. One good takeaway is that there's no safe harbor. If you think you're safe, the Tax Reform Act was retroactive, and so people built properties in Texas feeling good about the numbers, and then Congress passed a retroactive tax law that took away a lot of the financial benefits of building the property. And interestingly, in 1980s in Texas, this is a long way back, but we didn't have branch banking in Texas back then. A lot of people have assumed we've always had branch banking, but we haven't. And they've always assumed that we had other banks from other states in Texas, but that wasn't true in the 80s. So your client was your local banker, and they probably were in your town, and they only had one branch. Those people lent more and more on real estate as it became more and more lucrative, and they really got caught once the real estate went bad because of the Tax Reform Act and because of the savings and loan failures, which is a whole other story. But really, once those real estate loans started going bad, they simply became an anchor, and 450 banks failed. 9 out of 10 of the largest banks in the state failed, and that was the end of that.
If you go back during that period of time, and in fact, you can go back to 81 or so, and that was kind of the deregulation of the savings loan industry. In fact, I was just talking to my daughter who's taking a money and banking class at SMU right now and kind of giving her history perspective of what went on. Savings loans, the only thing they did at that period of time was home loans, and they would bring in money from a checking account and savings account, but the only thing they were doing home loans. But when Reagan came in, he wanted to deregulate a lot of the industries, including banking. And so they allowed people to savings loans now to pay higher deposit rates, which they couldn't before. So Michael, if you can remember this, you took in money at 5% and paid a deposit of 5%, you lent it out at 7%, and you were on the golf course by 2 p.m. It was a great way of doing business until the deregulation came in, then you had to pay depositors higher than 5%. And how are they going to be able to pay higher than 5%? The banks were going to have to lend on more riskier ventures. So instead of just lending on single family, they lent upon, say, multifamily or airplanes or construction loans or everything you can imagine that was a little bit more risky, they got into. And we kind of figured out that the savings loan people did not know what the heck they were doing, that's when all these banks started to collapse, and a lot of loans that they held went back to the RTC, really the OTS to the RTC, and the RTC was ones that were responsible trying to sell the assets. And so when Tony comes into the business in 1988, there was really no banks left standing. There was just a few. There was really no lending at that period of time, and the RTC was responsible for kind of doing depositions of what they were going to do with the properties, and a lot of these properties were purchased with pennies on the dollar for people that actually had the liquidity to buy the stuff. And I think that's a little bit of what a lot of people thought back in January, February, March, when coronavirus came out, that we were going to be decimated with occupancy issues and banking issues and things like that. But we really haven't been affected too much. So we're going to speed up to today, 2020. Tony, what are you seeing right now across the board on the impact of what coronavirus has had on multifamily?
Well, so far so good, I would say. It's definitely a market of markets. It used to be that the market before Corona was pretty homogenous, more homogenous every year, in that buyers were institutional, nationalized, debt was nationalized, and so there was a smoothing of the difference between a property in Dallas or LA or New York. That smoothing is gone, and now the markets that are being hurt, New York, the Cali markets like San Francisco and LA, the leisure markets like Vegas and Orlando, those are definitively out. And, Dallas, Austin, those are markets that are in. So people are asking the old school question of which market is it in? That question matters a lot more now than it used to.
And so what's happening in markets like Northern California and workers that used to have to drive in from their house in Silicon Valley to their offices in Silicon Valley now, because of coronavirus, have kind of been released, and now they can do their job any place in the United States. They've all started to leave that Bay Area and gone to other areas, whether it's Utah, still working for Facebook or still working for Google, but now telecommuting through Zoom like we're doing right now. What's going to be the impact of real estate in California and some of the things that are going on in California?
Yeah, that is happening right now. And as an appraiser, I separate things into that could happen or that is happening. And there's a few trends that are happening. We see them in today's rent rolls and today's operating statements. And it's not just in California. In every urban market, including Dallas, including Houston, right here in Texas, we're seeing in today's trends, there's a move away from urban from the renter, and there's a move away from urban in the buyer. And that's a today's trend. So there's a lot of softness in towers. I happen to rent in a downtown tower in Dallas, and so I'm a kind of a typical renter. I pay a premium to live here because I don't want to commute, and now I'm contemplating moving like literally millions of renters across the country thinking, why should I pay the 2x premium to live in an urban environment, plus all the fun of living in an urban environment? None of the theater, none of the music venues, those are all shut down. So all across this country, New York, any major market, California, where there's just a painful premium to live, New York, there's a painful premium. People are voting with their feet now as opposed to in the future.
And so we're seeing that in the actual rents that are kind of trading out from the prior 12 months to now. So we're seeing, kind of hearing headlines in, kind of Northern California of, 15, 20% lower rental rates and then kind of prior is a vacancy. We're seeing that as higher vacancies. And so obviously once you have lower rents and higher vacancies, that translates to valuation. Have you seen much transactions kind of actually take place in some of those gateway markets? And if so, what kind of impact evaluations are you seeing on actual traded deals?
Yeah, so we track those deals really carefully week by week, month by month. And here's what we're seeing. In Q1, we transacted deals that were already negotiated pre-COVID. They had hard money. Those deals went off. In Q2 and beginning of Q3, there was a bid-ask gap, and there just weren't any trades, and people really didn't bring stuff to market. Right now, the market is being flooded with new product, and there's a tremendous desire for that new product, and people are doing, it's like 100 confidentiality agreements and 35 tours and 5 offers in markets that are desirable. The markets that are not desirable are being carved out, and there's simply a bid-ask gap. The seller says, well, not only do I not want to sell at a discount, but I really can't because of my loan covenants or where I'm structured, where my basis is in the property. So there's just a bid-ask gap, and there's not really any trades in those markets, and yet you have this coming very robust trading period that we're just about to occur in all the have markets.
So San Francisco, New York City, virtually no transactions. Dallas, Denver, off the charts, right?
Game on, yeah. Northwest, lots of activity. The Carolinas, Texas is really ground zero. God bless us. We're sitting right here in Dallas, Texas, which some people consider to be the cornerstone of the country.
Yeah, and I feel that just from operating in Dallas and Austin. Austin seemingly has gone parabolic. Like every deal that is out there is sub 4 cap. And, it already was expensive and now it's more expensive. So thank goodness we already own a few deals because it's going to be hard to buy more down there. And then Dallas just seems to be that way too. So you're saying it's a tale of two different markets. You got your suburban and you got your kind of your urban dense deals. Are you seeing any stuff in these kind of on markets like Denver, Dallas, Carolinas, in the urban core? Are we seeing those deals transact and trade, or are we seeing any sort of impact on the rent rolls and pricing?
We're definitely seeing impact on their operations. Some of those properties in, for example, Houston, some in Dallas, some in NorCal, they're wounded, and by wounded I just mean they're off maybe 10 or 15%. Those properties will not be brought to market in 2020. They will push those until they recover or stabilize or smooth or something. So those properties will be brought off the market. The properties that we're seeing come to market in urban, people aren't excited about them. Pricing is not aggressive the way it is in suburban, where you say in Austin, it's a race to the bottom. We haven't seen our first two handle, but I've seen them in London, and I think we're due our first two handle here or in California, one of those two.
How are you seeing the difference in the grades of the multifamily? So we got our brand new Class A stuff all the way to your C class workforce housing. Are you seeing go back 7-8 years ago when we were kind of first buying our first deals? I mean, there was probably a 300 basis point spread between the top of the grade and the bottom of the grade, and here this year or last couple of years, really that spread has been within 100 basis points of it from Class A to the Class C. And are we seeing those even tighter now, or are they widened out at all? What's kind of your experience?
Super tight. It still catches my eye as I review appraisals, just because I'm so used to that nice stratification of the A's, B's, and C's, and the C's are really in play, which means low cap rates. Lots of 5 handles on C's, and that I've got to get my own head around that. But tight ranges between A's and C's, and so definitely a trend. I saw this in 2006, and I'm not predicting it'll happen again. But I did note this in 2006. The B's and especially the C's, the workforce housing, was bid up the highest in 2005 and 6. And when I started seeing that workforce housing go from 20 to 30 to 50 to 75,000 in 2006 a door, that really felt high. And for whatever it's worth, it fell the farthest. And that's where a lot of the air got taken out in 7, 8, 9, 10. And I'm not predicting that now, but that is what happened.
Well, I mean, I think you're seeing C-class stuff approach 100,000 and B-class stuff in the 120, 130 range, which
all day.
Blown right past it. It's amazing.
Yeah. When I saw the first stick in Dallas, we appraised a property up near 75 and the tollway, the Bush, and a guy built it. And the land seemed really expensive at the time. He paid like $20,000 a door for stick dirt, which is a lot. But he really believed in that corridor, and he sold for like $190,000 a door several years ago for stick construction. That was a real high water mark for me, which has been passed since then. But for us old timers to see stick go off at $190 a door, that's a lot.
What do you see right now in terms of transactions? We talked a little bit about rent control out of the Northwest or Northeast, and rent control coming to California. It is to a certain extent, but probably with Proposition 20. What's going to happen to all these properties that have rent control, and these people searching for other areas of the country to invest in, and what do you recommend for them to take their monies to?
Yeah, it's a good question. It's a complicated question. In the Northwest, when they added rent control, they predicted gloom and doom in the end of the industry. And right now, we just can't appraise them fast enough in the Northwest. So there's always a law of unintended consequences. In California, there's, virtually all properties have some form of rent control. And so we see it has a funny effect on cap rates there, in that the more rent control, the lower the cap rate, because the more people you have on the books at a below market rate. And if they ever get out of there, you can roll them up to market. So you've got all this great upside. So it's easy to have a 350 cap there. So in LA County, particularly, they have some legislative around COVID that pretty much says if you don't want to pay your rent, we're cool with that, and you can just pay it at the end. And if you really don't want to pay it at the end either, we're probably okay with that too. So that doesn't sound like a very good buying environment to me.
So New York City passed a little bit more draconian update to their rent control laws a year or so ago, and I was actually listening to an interview with some brokers from New York City recently, and they're talking about how like Manhattan cap rates have actually risen quite a bit, especially on the affordable product or the rent restricted product, because now they can't increase to market on vacancy. I guess they still have a control on that. They're talking that, cap rates in Manhattan are, pushing 6%, which sounds crazy on that stuff.
Yeah.
Is that kind of what you guys are seeing? And is Manhattan maybe the place to go by? Because it seems like everywhere else, like, who would have thought you'd see a world where Dallas or Austin had third lower cap rate than Manhattan Island?
Yeah, it's a weird world. And if you live long enough, it seems like everything just cycles through. So, and you remember how Manhattan in the 80s, Times Square, 42nd and Broadway, you'd get mugged at 42nd and Broadway. And today, that is the ground zero of the entire world to me, or maybe London Piccadilly Circus, but 42nd and Broadway, so the worm turns. It's really just like we were taught in freshman real estate economic fundamentals. There's a capital stack there. There's a stack associated with the cap rate that says there's a cost of money, and so right now the cost of money is really low. That has an effect. And then there's a risk allocation, and then there's an upside. And that simple little formula that we all learned at some point has not been revoked here in 2020. And so if you have less upside, then you have to get more of your return up front. So that's New York, if you have less upside. We saw some of the boroughs, like east of New York, overbuilt. And so they really started cap rates rising as they got overbuilt before COVID. We were seeing troubles there. But you can't revoke that law of mathematics that says the going in cap rate is a function of the cost of funds plus risk plus future upside.
Talk a little bit about, and again, a lot of people who just have gotten into multifamily recently, and they may have been in high school, they may have been in college in 2007, 2008, 2009, part of the great recession, the last one that we were in. And we talked a little bit about what, at the beginning of this conversation, what happened to the savings loan. What do you think was really the cause of, say, the 2006, 2007, and starting 2008, 11, the Great Recession when it comes to multifamily and multifamily financing, multifamily investors? Paint a little picture for somebody that asked, Grandpa Tony, can you tell me a little bit about what happened 10, 11, 12 years ago?
Yeah, it is an interesting time. And I'll tell you, the farther I go in my career, the less I worry about what happened and the more I worry about the takeaway from it, the lessons. Because it seems like the lessons are consistent, the takeaway is always different. So the takeaway for the start of this one was COVID. Well, that's quite a black swan event. How could you possibly predict that? But the outcome is still going to be the same. So in 2006, one of the interesting things about it, not to ramble too much, but one of the interesting things I find is that in my career, the people that I do business with has changed, or at least my clients have changed. And in 2006, we had a really interesting change in that we did business with the local banks in Texas in the 80s and 90s, and then they all went away, and we did business with the national banks that took them over. Instead of dealing with First National Bank of Dallas, we dealt with Nations Bank, NCNB, those are regional. Then they rolled up to JP Morgan Chase and the super banks, Wells Fargo. We did all that. Then came CMBS, and CMBS changed the world. And I had an impressive list of clients in 2006, and I'm telling you, this list of clients, none of them even have a listing in the phone book right now. If you go back and try to get Bear Stearns, Merrill Lynch, all these guys that they're just not even around right now. And so that was an interesting takeaway that CMBS left, then Freddie and Fannie came in. So the causes of the 2006, there have been books written on that. But one thing that happened was in housing. So the Fed funds rate went down from like 6 to 1%. And so everyone borrowed money on a flex loan based on that 1%, and the economics only worked on 1%. And then in 2006, they raised the Fed funds rate. And they had a thing called liar loans. If you guys remember what a liar loan is, that meant as long as you could sign the application, you qualified for the loan. Just put down whatever salary you feel like you deserve to earn, not what you actually earn, and we'll give that to you. So there was a complete collapse in in single family. And I could go on and on. There was toxic debt. There's a lot of things that rolled into that, but it reached a crisis in this country. If you weren't there in 2006 and 7, there was a crisis where Bear Stearns and Lehman were failing, and the masters of our treasury met and said, we think we've got like 48 hours before the world economy collapses. Like, we're 48 hours away from utter, unequivocal, apocalyptic disaster.
Yeah, I remember those days, a little bit of the big short. Then let's go forward with that thought that it did collapse. You know, the single family stuff, California real estate values of single families went down by 41%. Texas, not so much, because we just didn't have the ability for people to pull equity out of their properties. California and some of these other states that had kind of liberal equity cash out laws, they were using their homes as ATM machines, and that kind of stopped, you know, being able to spit out cash on your property every time your property went up in value. And so people in California made no more money than, say, in Texas or in other states like Phoenix or so. But, you know, they were just having properties go up and up and up in California. But when everything stopped and the music stopped, let's say 2010, 11, you know, what was going on in your world at that period of time? Was there lending going on? How were these transactions being financed? You know, was Fannie and Freddie still around in, say, 2011, 2012?
Well, I take comfort in this, in that every time someone says this time it's different, for me, that is a flag that says this time it's not different. So I don't believe when they say this time is different. But in this case, I will say the math of it is this. In 1988, there really was no such thing as a real estate, just a matter of terms or whatever. You just couldn't get a real estate loan. And in 2008, 9, and 10, there really was just no such thing. The banks had a very odd situation. Banks refused to make any loans, and the Fed actually made them take money. They physically forced them, and they took bags of gold and they put them in their vault, and the Fed said, now go lend. And very oddly, all the banks said, we are not going to lend. We're just going to sit there and collect, you know, whatever Fed funds rate on that money. But they would not lend. They called every note due, and I walked with many a developer, very sadly, walked through their properties. They had built a great property. It was cash flowing. It was a fantastic property. It had rolled over, and the debt was due, and there was simply no one to make loans. So to me, that's a big marker of the difference between that time and today, is that at that time there were no loans, and yet today Fannie and Freddie have $100 billion to lend and low rates, and they're competitive. So that's really a giant difference.
So that property went bad because it came, the maturity of the loan came at a bad time and you couldn't refinance, or you couldn't sell it because the person that was trying to buy the property, there was not any lending to be had to try to buy that property in 2010, 11 or so. One of the things I remember, Tony, you spoke about maybe about 5 or 6 years ago at a conference that I attended, a lunch that I think that you were speaking at. And I was talking a little bit about if you were able to hold on to the property, you being a borrower, you being the sponsor of a deal, or you were a lender of the deal, that you didn't want that property to go bad, meaning that foreclosed upon, if you were just able to hold on to it for a period of time, kind of during the recession, because recessions, I think you said, are not very long, and you can probably kind of correct me on that. But if you held on to it, that the upside was unbelievable. Can you tell us a little bit more about that phrase or that thinking?
Yeah, I remember that very well, even though it was, 10 years ago. I just remember that I happened to have a fantastic amount of data. And like any good appraiser, I'm a data wonk. And so I just sat down and looked through all this data to see what it told me as opposed to reading an article of someone's opinion on it. And I came away with 3 or 4 really powerful takeaways. And one of them was, here's a couple of good ways to get your property foreclosed on. Have your debt come due during a period of time where there's no such thing as a real estate loan. That's what happened to a lot of people. I walked with a lot of owners on their properties for the foreclosure appraisal. So the takeaway was, don't be so flippant about 5-year, 30-year ammo, 5-year call. That 5-year call, be more careful of that. And 2, the people that got their properties foreclosed, they were so leveraged that they couldn't withstand the moderate dip in cash flow. So when I went back and traced the data, the cash flow dip was not catastrophic. For A's, B's, and C's, the C's dropped the most, but the rents were 10, 15% off, and the occupancies were 5% worse, 500 bips worse. So really, all you needed to do was be able to survive that cushion on a cash flow basis, which just meant a little less leverage, 60 to 75 instead of 90. That leverage looks so appealing in that market, but it has a bite.
In this last cycle, I guess, kind of leading up to the 2020 recession, we'll call that a recession because it was 2 quarters, but the banks were not nearly as aggressive and flippant as it was, obviously, in kind of the run up to 2008, where, you would get, 90% leverage, like you mentioned. We started seeing a couple of the bridge loans that would go to 85%. But that was kind of really the outlier. Most of your traditional banks and the agencies and what limited CMBS was a player in the space leading up to it. They all pretty much capped you around 75 to 80 and made sure you had, in place income and made sure that, kind of adjusted underwritten expenses could make you have a 125 cover. So they had a natural margin where, me being a banker kind of leading up to the Great Recession, I mean, it didn't really matter. We'd do policy exceptions all the time, and we'd underwrite, pro forma income and pro forma expenses versus, actual income. So it didn't seem like the system was fundamentally, the banking system was fundamentally in much better shape going into this 2020 kind of recession that we found. So I didn't seem like we had a bunch of assets that were, improperly underwritten from debt and over levered. Not saying that we won't have ultimately maybe some issues kind of coming out of this in certain pockets, certainly in the no-fly markets like you were describing earlier. But from what I saw in Texas, everything seemed like it was underwritten pretty conservatively. So where do you see us kind of going here as we finish out 2020 into 2021? Are you seeing that we still would have a pretty robust, healthy multifamily market and kind of the on markets, and how much pain do you anticipate actually hitting the marketplace? And I know you're saying right now these guys aren't selling in kind of the off markets. Are they going to become a forced seller here, and we start seeing blood in the street? What's kind of your thoughts?
Yeah, good questions. Well, back to 2006, we did deal after deal after deal after deal where they were financed on pro forma income, and the truth is, it wasn't really, it was pro forma income. They were never going to hit that. So the debt coverage ratio didn't work from day one. Unless they grew legs into that pro forma, they were destined to fail. And once we started losing jobs, then they didn't grow into that. So that was really where the big misses were in Class C, especially Class C. So looking forward, I just have the same crystal ball everybody else has, but I learned something, Mike, in that recession. Another piece of that analysis was this. And I'll tell you what it is, and you can take away whatever you'd like. But one thing I discovered was I tracked all the occupancy and rental rate data after the big shock, the day we almost died. And for months after that, the performance of apartments was really quite placid. So everybody was in the 90s. And this is what I realized. In that market, when you get the employment shock, and I think real estate apartments are driven by jobs. This is my indicator. I don't really care about GDP growth or that kind of stuff. I don't even really care about how many units you're building. I care about jobs. And so in 2006, we stopped having jobs. That became a big problem for us. But the market didn't react for about 6 months after that. So this is the big takeaway for me. Don't be lulled into a sense of, there's a tsunami offshore. Don't be lulled into a sense of security if 3 months after the jobs shock, your apartment is still performing well. It's possible that there's a tsunami that's going to break offshore. And my theory is because of this. My theory is because people their leases haven't expired yet. They haven't lost their job yet. They haven't moved back home yet. They haven't doubled up yet. They haven't moved into a lower class apartment yet. But all that is coming. So the question is, we've had another employment shock. It's the worst we've seen. So Tony's tsunami theory would be that we would start seeing performance drop 6 months after that occurs. We've probably pushed that out with the fact that we have so much Fed money sloshing around, But Tony's theory is that's gonna happen.
And that's Q1 or Q2 of 2021, and Tony's theory?
It is. That's Tony's theory. So as an appraiser, I just hold my mirror up to the market, and I write whatever the market says. So don't think that Tony's theory works its way into my appraisals. It doesn't. Whatever the market thinks, nobody cares what Tony thinks. I don't put Tony's opinion in the appraisals. If buyers are optimistic, I'm optimistic, and if they're not, then I'm not.
How long do you think that impact takes to stay within the multifamily space before, everything kind of snaps back?
Well, last time it was 12 to 18 months.
Okay.
And, it came back with a vengeance. Some people feel like we've already had that. There's as many theories as there are people, but since you asked for mine, that's one path that the future might look like is we might get some weakening in Q1 and 2 as the chickens come home to the roost with employment, since I believe that's our indicator.
And do you think the on markets are going to be a lot less impacted than the off markets? Is that kind of your going theory?
Clearly.
Yeah.
Clearly, yeah. Just as A, B, and C are impacted differently. The A's got a cold and the C's got the flu. Texas will get a cold, and New York and Northern California might get the flu.
Yeah.
Maybe. Yeah. Predicting the future is tricky business.
It certainly is. A lot of the people, again, who haven't been in this business for a long period of time may not know exactly what an appraiser does when it comes to multifamily. They understand what a single family appraiser does. And what are some of the things as an appraiser that you could coach and advise, new borrowers, new sponsors that are buying their first deal or buying their second deal? What helps an appraiser help the borrower?
That's a great question. We want to work with the borrower. We want to be their partner to make sure we turn out a good appraisal. That's a fair appraisal, but an appraisal is an opinion of value. It's a range of values. And so we want the borrower to tell us things that they like about the property. If they feel like they're, superior to their competitors for a reason, then we want to hear about all that. Having all the data is always really important to us, and we like them to be relatively honest with us, not try to put up a front or hide things or miscast things. But the appraiser should be easy to work with. They should kind of be your partner on the appraisal.
Mike, you've purchased a lot of properties in this last few years. You were a banker prior to that. What is your advice to new people when it comes to dealing with in helping appraisers come to a correct value or a value? It doesn't have to be the correct value, but coming to a value. What do you do that's maybe different from everybody else?
Value's not really ever a problem, but dealing with the agencies or life companies or the various lenders, the one of the checks and the way they underwrite is really, they don't really care what pro forma income is. And this, Paul, they take kind of the historical income. So it's typically your T3 rental income of your T12 other income. And that's kind of the underwritten income. And it's really in the expenses. So, we're going to go buy a property and I'm going to pay $50 million and it's currently assessed at $35 million for Dallas County. And then, so how do we bridge the gap? Because we know it's going to go up. So I'm going to try to say it's going to be 85%. And then the bank's going to try to say it's higher, but we need to get the third party, the appraiser, to buy off on whatever our actual number is. And that's what they're going to plug in the pro forma NOI number they're going to get to then back into a 125 debt cover. Same thing with the insurance, same thing with repairs and maintenance and maybe advertising and payroll and all the various line items that we have. So that's really probably the most interaction that we don't necessarily directly have it with the appraiser, but kind of through the lender. Those are the things that we have. So early on in the process, we're going to say, hey, we own 4 buildings in the area. We think that, we should the seller's underwriting at $1,600 payroll, but I have these, 4 buildings that are reasonably comparable. And I think I can underwrite at $1,350. Can we get the appraiser to sign off on that number? So the lender will sign off on it. And then we can actually get a higher NOI and more loan proceeds. And that's really kind of, I think, some of the art of being a professional multifamily operator and just really kind of understanding, the roles and responsibilities and who has to sign off on what and to get an NOI that the lender's going to underwrite to, and the appraiser's a big part of that.
Yeah, the appraiser is a huge part of it. I view appraisers almost like accountants. that it's not emotional, it's just factual, and it's all really based on numbers. And so if you do have any issues that you need to kind of work through, that you think that the appraisal, now we haven't had that recently and about valuation concerns on properties, but maybe what Tony's telling us through the tea leaves is that if occupancy and collections are going to have some problems coming up here in the second or third quarter of 2021, maybe we will have some issues on valuations of properties. But, you just have to put your emotion aside and just talk factual and think of in the eyes and the brain of an appraiser.
And Tony, correct me if I'm wrong, but what Tony's looking for is support to back up a number. So if he doesn't have it and I can provide him reasonable, realistic support that I can take payroll from 1,600 to 1,350 or 1,400 or whatever it is, that's what he's looking for, is kind of comps and data, because like he said, he's a data wonk. So he needs something to back up that assertion when he signs that appraisal and sticks his neck out to the bank that he signed off on it. So if you can help the appraiser get the data he needs to support a certain expense item, that then helps your NOI from the lender and helps your loan proceeds. So I think that's it's really the way I view it, at least.
What pisses off an appraiser, Tony?
Well, I'll just say, Mike, I think you really captured the essence of it. If you feel like, because it's a range, no one knows exactly what the payroll should be, right? You're a buyer. We're just trying to represent what a buyer thinks. And if there's 5 buyers, they're going to have 5 different opinions. So there's not really one opinion of what payroll is, but you really nailed it. If you've got data that supports it, we're wide open. We have no dog in the fight. We have no agenda. And if there's a reasonable reason for payroll to be lower or for anything to be lower or higher, we think we compete because of this reason. Sure, we're just wide open. Like you said, we're accountants. So the question, what pisses off an appraiser? Well, that's a good question. We like to be reasonable, and so we have a hard time. We're frustrated by people who aren't reasonable. And unreasonable to us might look like, I'm not going to give you the data you need, but I still demand to have the appraisal, as the owner. So the smartest guys that we deal with, the most successful guys we deal with, give us our data and ask us, how can we help? And it seems like the smaller operators often give us pushback and say, I don't really have time for the appraiser, and you guys are only supposed to have that data, and you kind of work for me. So the bigger the developer, the more eager they are to say, here's your package, let us know what else you need. We'd like for this process to go smoothly.
Yeah, because at the end of the day, if the bank needs the appraisal, the bank does an appraisal, they can't give me my money. If I don't get my money, I'm not going to buy the deal. So that's just kind of the way the world works. So, you being difficult along the way just is counterproductive, so helping your people get what they need is good business.
I agree. And I've walked with people who they're doing a 20-plex and they send, their first-year guy out and they don't have any data and it's just a big mess, and it just makes for a frustrating appraisal all around. And yet you go to one of Sean Todd deals, it's a $300 million deal. Todd will personally walk the deal through you. He wants to make sure you understand it. He wants to make sure you've got all the data, and how can he help? That's a class act.
Any words of wisdom to some brand new operators looking to get into the business? Is now a good time, or should they be on the sidelines waiting for anything in the future to happen? What areas of the country? These are a lot of things that are just internal gut things. But what's your 2 cents right now, Tony?
Yeah, I can give you a couple of truisms. One is fortunes are usually made in down cycles, not up cycles. So I hope we don't have a down cycle, but the real estate industry is unequivocally cyclical. So that's the first thing to know as an investor. We have not revoked the cycle of real estate. It will go up, it will go down. 2, fortunes are made in down cycles. 3, don't be afraid to be a little contrarian. In 2006, as we pulled out of it, everyone wanted urban. And so 8, 9, 10, 11, 12, everyone went urban, and they didn't have much use for the suburban. So the folks that got into suburban in those markets have cleaned up. So fast forward to today. No one wants urban. They all want suburban. So there might be a takeaway there that says be a contrarian and, stay away from the crowd.
How about secondary or tertiary markets these days? Any insight on that, since you guys are all over the country? Anything to... get some insight on?
I've always liked the secondary markets. They always feel rock solid to me, rather than compete in Dallas or Austin, where it's just the competition is brutal. Why not go out 100 miles, go to a secondary market, and get 50 more bits of yield, and your cash flow might be more stable there than it is in a big market. So I like secondary markets. You're not competing with the institutions either. If you're in Dallas or a major market, you're competing with institutional money, and that's tough for the individual appraiser, the individual investor. You should stay away. If you find institutions competing for your property, you need to find a new class of property.
Certainly true. Michael, any last minute questions to Tony, since we have him tied up in the back room?
No, I appreciate what he said. It's good to see that. You guys are talking about the 80s. I was in junior high school, so I didn't get to participate, I guess, from the RTC days, but certainly lived through the Great Recession and the Grim Reaper, decade or 12 or so years ago, I guess now at this point. Time keeps going by. I used to be the young guy, and now I'm not the young guy anymore. But it seems to make sense. I mean, I think what Tony said about being a little contrarian makes a lot of sense. We own a ton of suburban multifamily, and some of the stuff we're looking at here that seems kind of like value to me. It tends to be maybe not kind of the downtown super urban core towers, but at some point that's gonna make some sense if you're gonna pay the same or similar cap rate for something that's 50 miles north of downtown Dallas, you can for something a half a mile north of downtown Dallas. That might start making sense at some point. One of the things I think that the guys, like the three guys on this call, you, Paul, Tony, and myself, is we have the benefit of perspective. So we look at like a lot of stuff. I try to literally see every deal that's in Dallas and Austin, which are the two markets we focus on. So I try to like literally see everything. I'm saying I do, but I see the vast majority of it. And Paul, you've done, a bajillion loans, and Tony's done more appraisals than probably anyone in the country. So having that ability of perspective and just kind of seeing so many different transactions, I think is really helpful from the point when you're looking at 100 deals, trying to find one. Eventually you're like, this doesn't work. And eventually one of them works, and you have the ability of perspective because you just saw so many of them. You're like, damn, this is a good deal. And it's kind of an innate sense to it. And I think that's what repetition experience is. And, certainly, a guy like Tony has quite a bit of that to share with everybody.
He certainly does. That's Tony Lenamon with JLL. Obviously, he's been doing it for a long period of time. Great words of wisdom that came out of Tony. And so, I can't thank you enough, Tony, for coming back on and hanging out with us. I always get, great information from you and your team across the country. You guys do great appraisals for us, and we certainly do appreciate that. So keep up the great work. And again, thanks for hanging out with us, Tony.
Yeah, appreciate you having me. Let me just say this as my closing comment. From a demographic standpoint, from a property class standpoint, the attractiveness, you could argue that there's never been a finer time to get into the apartment business, regardless of what any given quarter blips up or down. But there's so much demography, so much asset desirability, all the trends. It might be for a young guy, might not be a better time in history to get into the apartment business.
Interest rates with two handles don't hurt either.
Yeah, we won't see those again.
Certainly not. Okay. Tony Lenamon with JLL. We certainly appreciate it. Thank you very much, Michael Becker. Always a pleasure. I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.